Oh my God, guys, have you seen this video from Sven Carlin, PhD? Warren Buffett is predicting a stock market crash like the 2007 to 2009 stock market crash when we had a global real estate meltdown. So let's react to this video and see what old Svenny boy, Dr. S, has to say.
Buffett has been piling up cash as he did before the 2007-2009 financial crisis. This is indicative of something. He says he can't predict markets, but he did it well here, and he's doing it again here.
Okay, I'm not the expert on the financial crisis, but basically in the United States and, generally around the globe, people that couldn't afford mortgages were given homes. They were able to buy homes. And those mortgages were packaged up into mortgage-backed securities and handed out like candy everywhere. And people thought that these mortgage-backed securities were super safe. You're just investing in mortgages. What they didn't realize is that the vast majority of these had a bunch of toxic mortgages hidden there. And eventually, people couldn't pay their mortgages anymore. And the value of these mortgage-backed securities were suddenly in question, okay? And I don't know, maybe I'm wrong. I don't think Warren Buffett necessarily knew what was going on in the real estate sector, or I don't think he necessarily predicted the meltdown in markets with the mortgage-backed securities and all the bets that were made in the background on them. I don't think he predicted that, okay? I don't think anybody predicted it. And on top of that, even if he did predict it, that means nothing about the future. And on top of that, this current scenario is not like that scenario. Are there a bunch of toxic mortgage-backed securities being held around the globe? Is there a massive bubble in the real estate market where people aren't going to be able to pay their loans soon? And there's a bunch of bets being made in the background? I don't think so. So just hearkening back to 2007, a totally different time, a totally different scenario is BS. Maybe there's something else going on now, but you gotta look at it in context, okay? You can't be obsessed with all these past market crashes. Oh my God, see, it's happening again, whoa! Let's keep watching.
News is that over the last 2 years, Berkshire has sold 132 billion more in stocks than they have purchased. And Warren Buffett says that market timing is both impossible and stupid, but
there you have it right there. Market timing is both impossible and stupid. But he's predicting a crash? You know what Warren Buffett might be doing? Maybe he had some stocks that did well, and he said, you know what? I think these are a little overheated. Maybe they're massively overheated. I got some good returns. I'm going to sell these stocks. And I'm going to put it into treasuries, which are paying 4 or 5% now. Because maybe he just got the gains that he wanted, or maybe he thinks the stocks that he invested in were not good or were overvalued. And maybe he's just waiting for other opportunities. Maybe that's what he's doing. Okay? So, and also treasuries are paying 5%. I mean, come on. There could be 1,000 reasons that he's selling more stocks than he's buying. It doesn't mean he's predicting a market meltdown. And what are you going to do? Buy Sven Carlin's course because the S&P 500 might have a meltdown? No, there's other alternatives to that, including just DCAing into the S&P 500 and the world, of course.
But, okay, he might not be timing the market, but he is certainly preparing for something.
Oh my God, we're at the peak. Look, 24.5% and 25%. Oh my, wow!
As he did in the past. What does it mean for us investors? Let's see at the market and the opportunities from a value investing perspective, which is what we do on this channel. The first and foremost perspective I want to give you is the current S&P 500 price to earnings ratio that has spiked up in exuberance, and it is 30 compared to half of the historical average.
I'm sick of this, okay? This was a different time where corporate profits were not as high, okay? Back in the day, it was mostly banks and oil companies and GE and stuff like that were the dominant stocks, okay? Now we have tech companies, which are insanely profitable, hyperscalers, okay? And they have global exposure now. That doesn't mean you just buy the S&P 500, but they have global exposure. So when you're looking at the PE ratio, generally companies that are growing earnings faster have higher PE ratios. And if earnings of these mega cap tech companies are growing fast because they can keep growing fast because they have global exposure, keep growing fast, but guess what? Oh my God, you're going to have a higher PE ratio. Okay, it's all about the components of the market. All right, yeah, like a bank isn't going to have a high PE ratio. Or an oil company is not going to have a high PE ratio. But even a bunch of tech companies that are growing earnings fast, okay, yeah, it might have a higher PE ratio. And if you look at the average over the last 20 years, I mean, the average seems to be a little bit higher. Okay, so if you average it out, well, 25 maybe. I'm just eyeballing it, 27. Okay, it's a little more aggressive than normal. But that doesn't necessarily mean maybe AI, my hot guy, will lead to more profits in the future. The market's pricing that in. Maybe. You don't know. That's the problem. It's all guessing. It's all pulling numbers out of your butt. But just because the number is bigger, we're going to drop 50%? Oh my God. No, stop.
If we go back to the historical average, there is plenty of room. And the markets also sometimes tend to overshoot on the downside in panic. And that could be a big issue, especially if interest rates.
Oh my God, the market's going to drop 50%. I am selling everything and buying Sven Carlin's course. I'm going to buy multiple copies of his course.
Stay higher for longer. Interest rates move in a cycle. Now there was commotion, the Fed lowered rates, then will it be as planned? That could be the game changer for also market valuations. Bonds, this is the last news, rethink their rates and the projections. The bond yields also went down when the Fed cut, but are now back to previous levels, saying that we might not see the cuts that everyone expected, which then again impacts also valuation and everything else. If we compare...
Yeah, but how does that mean it's going to drop more than 50%? Okay, maybe rates stay higher a little bit longer than expected. Okay, maybe they do. Why does the market have to drop 50% because of that? And the Fed has done a good job overall, I think, because of inflation. The inflation year over year has come down. Now the rate of change has slowed down. Okay, the total inflation has gone up because we had a lot of inflation in the past, but the rate of change has dropped pretty precipitously. I think overall they've done a decent job. Okay, now we're worrying about like minute, oh my God, it might be 2.8%, oh my God. Like, it's not as bad as you might think year over year. Okay, stop. What are you going to do? What are you going to do with this information? Tell me. What are you going to do? I know what I'm doing. And I have a long time horizon. What are you doing? What are you going to do with this? Short the S&P 500? Buy put options so they expire worthless? Come on.
Interest rates and valuations, this is the S&P 500 ratio that has been growing for the last 40-something years. So valuations went from 7, yes, P ratio of 7, to the current 30. And if we want...
The market's just so dumb. They just don't get it, okay? They don't understand the brilliance of Sven. Markets are so inefficient that there's no reason. It's just pure exuberance, bro. Oh, and this is just the S&P 500. Even if this is exuberance, this is just the S&P 500. There's other ways you could invest, yeah.
Want to smoothen those ups and downs recessions, we take the 10-year average earnings P ratio, and you can see here again from the 1980s has been nothing but growing in line.
PE up, bad. PE level, good. Nothing else matters.
With interest rates that have been nothing but declining since 2020. And interest rates have risen, but valuations have not gone down on the expectation that interest rates will decline and will stabilize at 2%, 2-3% for the longer term. However, if interest rates don't stabilize and we are in an upward interest rate cycle, you know what happens to valuations. Valuations go down, and that might be the key risk for investors, and also something that Warren Buffett might be watching. He says not to predict, but always look at what he does, not what he says. We have looked...
You're assuming he's doing something for reasons that you're making up. You're guessing what he's doing. Okay? You don't know why he's freaking doing what he's doing. And even if Warren Buffett does do something, he could be wrong. He's been wrong sometimes in the past. Everybody can be wrong. It doesn't mean anything.
Looked at food prices in this video, and if food prices go up and food prices have not been adding to inflation as there has been a downturn, but those did in the past, then we can
If the dinosaurs come back and they eat everybody, oh my God, what's going to happen to inflation then?
immediately see higher inflation, and that's just one of the factors out there. Then we see here unemployment really good, so if you lower interest rates, you might spike up inflation even more. However, there is also this conundrum: the global debt levels, the burdens that cannot simply be sustained with higher interest rates. The whole deficit of the US budget should be going to net interest payments if interest rates stay at 5% for longer. That would really put things into trouble, and therefore maybe Buffett is saying nobody's going to give money to the US if they lower interest rates, because this debt to GDP situations are unsustainable, especially if there is a recession or something. And therefore Buffett might be thinking that there is a possibility that interest rates don't go lower, that we are in an upward interest rate cycle for longer, and if that happens, and if the lower interest rates expectations are not met, valuations must decrease. And if we have valuations going just back to normal or staying at 5%, then the average P/E ratio for the S&P 500 historical perspective should be 15, and that means a 50% crash for stocks, and that means Warren Buffett will be buying again. Yes, time.
He's just as bad as somebody that pulls up the chart of QQQ over the 10 years and concludes that they should only buy QQQ because it went up a lot. He's looking at the past. It's irrelevant. In the long run, it's all about the future. The past is irrelevant. Stop fixating on the past. Things change. It's different this time, bro. Maybe it is. Okay? You don't have all the information. You're one person. You have a job, hopefully, unless you're day trading with Chris Sane. You don't have the total understanding of what's really going on to really make an informed decision. That's why you buy a total market index and you hold it for your entire life, or until you're freaking old and you sell it. Okay? That's the best you can do. You get the market return. You don't listen to Meat Spin Schvin, sell S&P 500, and buy his course. That's not the solution. That's basically what he wants you to do. Buy my course, bro.
Timing the market is impossible. His cash peaked in 2005, 3 years before the crisis. But what we can do, and we must do as value investors, watch the fundamentals, watch the price we pay in relation to the fundamentals, the earnings we are getting. And Warren Buffett is watching. He says, I will not pay P ratio 30, 1.5% dividend yield for the market, too expensive.
But timing the market, he said timing the market's not good. So what do you, oh, the S&P has a PE of 30, so therefore I'm not buying any stocks. Some stocks, a lot of stocks don't have PEs of 30. That's just the S&P 500s. It doesn't matter.
Expensive. I'm happier with short-term treasuries that give me 4 or 5%. Of course, that is because of his size. He cannot just go around the world and spend his hundreds of billions. He has to wait for that market cycle to revert, to buy big. But we as smaller investors, we can look globally for opportunities. We discussed Europe this week, Austria, etc., etc. Warren Buffett will not buy a billion-dollar company in Austria. So there are already opportunities out there, and we can prepare for what it looks like eventually will come, because
oh wow, global investing. What a genius. Should I buy your course, or is there another way I could possibly globally invest? What could I do?
sooner or later the interest rate cycle will revert. Thanks for watching, and I'll see you in the next video.
What a freaking clown. All right, what do you guys think? Do you think Sven Carlin has deep insight into Warren Buffett's thought process? Do you think Sven Carlin is a genius and you should buy his course and buy Austrian stocks only? Or do you think there's another alternative out there, another solution? What do you think? Have a wonderful day. Cheers.